Hi everyone. So through these videos, what I'm planning to do is that I am going to share with you about some of the stuffs which I like doing, researching as well as analyzing. So I plan to divide it into various buckets. So this channel is an initiative from my side to basically spread knowledge as much as possible. So I would be talking about geopolitics, I would be talking about certain issues regarding economics, about finance, about law. So I will divide it into these buckets and accordingly I will deal with it. So today I want to talk about a very interesting topic which I believe is something which is close to my heart, which I've even talked about on X with the help of Grok. So, and also shout out to Elon for releasing the Super Grok model. I'm looking forward to that. And this topic is called securitization. It's a finance topic. So, basically, securitization, if I would define in simple words, it is transformation of financial assets into securities. So, basically, when you have a loan receivable, which basically refers to an outstanding loans which are given to an originator who is basically a bank or a financial institution who has lent to the borrower and is still owed. So that uh, receivable gets converted into an asset based security and it is sold off to through a SPV or a special purpose vehicle to investors, and accordingly the securities are issued to investors. So basically it's a model on the basis of which assets are packaged and sold as securities to the investors in return for profits which are realized from the valuation. So we know there are a lot of methods in funding. So traditionally the method is equity financing as well as debt financing. Equity financing can be issuance of shares or venture capital or private equity, and debt financing includes by bonds or by any unsecured instruments like commercial papers or loans which carries interest. So securitization is something which is very different, and it originated initially in the mortgage markets, which was in the US from 1970, and it became popular in 1980s as banks try to take advantage of the regulatory arbitrage possibilities. Now, basically, this is an off-balance sheet treatment. So basically, what it does is that it there if there are recourse obligations and retention of residual returns that are required by the seller. So any of these sort of financing can be done off the balance sheet rather than on the balance sheet, like any traditional equity financing or debt financing method. Now, it was heavily being done from 2000 onwards, but then one thing hit, that was the 2008 crisis, and we saw how subprime mortgages was sold an innumerable number, and it created an asset bubble and then it burst. So basically there was failure of underwriting standards, there was failure of due diligence. So there was basically banks were giving ninja loans, which are basically no jobs, no income, no assets base of any credit enhancements or any credit ratings which are being done. So they were just giving off these securities and they were selling it off, and as a result of which basically originators were not having a skin in the game. The process was not transparent, and then we required regulations, and then the financial crisis of 2008 taught us this, that we would be requiring such a model. Now securitization has been taking place and it has re-emerged as a refinancing institution. So broadly, my scope of this video is to educate you all what is basically securitization in India, with the key components of securitization exposure, as well as the recent trends that I have seen in securitization, which I wanted to give you as my headwinds conclusion. So in India, basically the process is that there is an ARC. Now, what is an ARC? ARC is a specialized financial institution that buys NPAs from banks and financial institutions so that they can clear off their balance sheet of these NPAs, so that there is less provisioning of these NPAs and better realization of profits. Now, what are NPAs? Now, NPAs are basically, these are assets. So what is a loan? A loan which a bank gives is an asset for the bank. Now, if that loan is not repaid for a period of 90 days, then it becomes a substandard asset. Now, if it is not paid above 12 months from the 90-day period, then it becomes a doubtful asset. And above the 12 months, above that also, if 12 months are passed, then that becomes a loss asset. And this asset basically the banks sell it to the ARCs in lieu of security receipts, so that the banks typically sell it at a haircut, and ARCs then issue security receipts, and in turn of that they sell it off to the investors and realize profits on the basis of that, as much as possible, whatever they are able to recover. So this headache is not taken by the banks; it is taken by the ARCs, which are the asset reconstruction companies. Now, what happens in India basically is that ARCs acquire the financial asset of the borrower and pays cash to the bank, which in turn issues security receipts, which are given to QIBs. Who are QIBs? QIBs are the qualified institutional buyers, who are basically mutual funds, pension funds. So basically all these big, large scale institutional investors. So they raise funds by buying these distressed assets from the banks, and basically the whole game is about the valuation. So whatever valuation is realized from this distressed asset, that basically the ARC is able to sell it off to the QIBs in lieu of profits, whatever they gain out of it. So it helps banks to basically clear off their balance sheet from all these loss assets. Now, India, however, follows direct assignment and pass-through certificates, which I will explain later on through ARCs and SPVs, which basically I will explain what is the direct assignment and pass-through certificates later on. I'll come back to it. Now, I want to talk about the key components of securitization exposure. Securitization notes are basically, so it's divided into securitization notes and credit enhancements. So basically, so securitization notes are securities which are issued in a securitization transaction representing an interest underlying a pool. So it is given in tranches. So there are 3 securitization tranches, if I may say so. They are basically the senior tranche, mezzanine tranche, and junior tranche. Senior tranche is the highest rated tranche with the lowest risk exposure. Mezzanine tranche is the intermediate tranche, which is basically middle priority, moderate risk yield, and junior tranche is the lowest rated tranche, which absorbs the losses first. Now, what is this absorbing the losses first? But before that, you have to understand that there is a system called cash flow waterfall. Now, a borrower makes payments on the underlying loans, then cash flows through a predetermined hierarchy. Senior tranches get paid first, then comes the mezzanine tranches, which are the middle tranches with a moderate risk yield, and then comes the junior tranches, which absorbs the losses first. So first loss facility is basically what it's absorbing the losses. What I am trying to mean is, first loss facility is the first layer of protection against the losses in a securitization transaction. However, seemingly it doesn't include excess spread. Now I'll come to what is an excess spread. So it is not basically provided by an originator or a third party. Now, excess spread, if I may say so, by a simple example, let's say if a securitized pool of mortgages generates 11% interest annually, and the coupon rate, which is basically the annual interest payment rate which is paid to the investors, is 10%, so the excess rate is 1%. Now this 1% is basically which covers the potential losses for the defaults or non-payments. Now, what I was talking about was, one is securitization notes, and that is credit enhancement. So credit enhancement basically enhances the credit profile of the securitization notes. How it does it is through either cash collateral, if you have it as cash, if you keep it for in a securitization transaction for against potential losses from a default or delinquencies in the underlying assets. Then there is subordination, which is basically the cash waterfall system which I talked about. There is excess spread, and there are other forms of guarantee payments like over collateralization, which is basically the excess value of the asset is transferred to the funding raised by the originator. It serves as a credit enhancement, but if subordinated, it is not counted as a first loss facility. Now, what I want to talk about is basically the analysis that I made in terms of the securitization trends which I'm seeing nowadays. one of the latest notable developments which I see in 2024 was the rise in the CLO developments. Now, what is CLO? CLO is basically a collateralized loan obligation. So it is a type of a structured finance investment where a pool of corporate loans is packaged and sold as security to investors. Now, essentially, it's a structured debt instrument backed by a pool of loans. So, what basically distinguishes between a CMO or a collateralized mortgage obligation vis-a-vis a collateralized loan obligation is that it is more CMOs are backed by mortgages, CLO is backed by loans. Collateralized debt obligation is a hybrid of this. So, these are called CDOs. Now, what I have basically seen nowadays in the markets is that in US particularly, there has been a record issuance volume of USD of 85 billion, which is 195% higher than the issuance last year, and European CLO volume registered around Euro 46 billion, which is substantially higher than last year. The growth of the CLO market is a direct result of the activity in the leverage loan market. Now, basically, what is a leverage loan market? It tends to be syndicated. Now, what is basically a syndicated leverage loan within a securitization transaction is refers to a loan provided by a group of lenders. So, to a company, particularly with a lower credit rating, that is packaged. This particular loan is which is sold off by a group of lenders to a particular borrower company is packaged and repackaged and sold off to the investors in the secondary market as securities. So this process where the loan is syndicated or distributed among the multiple lenders and then securitized allows the investors to spread the risk and also gain in realization of values from the high yield assets. So this is a syndicated leverage loan. So basically CLOs have been the footstock of these syndicated leverage loans, which has been done by various banks in the present time. While we also see private credit, which is a very interesting topic, I'll talk about that in another video if I can. Private credit finances are also making increasing inroads into the finance space, but this leverage loan market, the syndicated leverage loan market, which comes from the CLOs or the collateralized loan obligations, this has kick-started a lot and it has grown a lot in the current securitization trends that I'm seeing. Another way, basically, how CLOs are basically given access to the investors is through ETFs. Basically, it involves pooling and packaging corporate loans into different tranches of debt securities. Now, I want to talk about how basically in India's securitization is different from the rest of the world. Now, India basically follows two ways of securitization. One is, as I said, that was in terms of bad debts or NPAs. Second is basically called direct assignment, which is basically transferring a pool of loans or assets directly from the originator, which is a bank or an NBFC, without an intermediary like an SPV or a special purpose vehicle. So, investors in a direct assignment transaction has to conduct due diligence on the underlying assets, as there is no SPV to manage the portfolio. So the cost to the originators is typically lower in a DA transaction due to fewer parties involved. Now, a PTC on the other hand, or a pass-through certificate, is a way for investors to participate in cash flows generated by a pool of assets without directly owning the assets themselves. So a pass-through certificate is a type of a securitization note, okay, which is used in securitization transactions. It represents the cash flows which is generated from those assets which investors receive as a percentage of a share in the pool of assets. So that is how a PTC is done. So essentially it is basically how cash flows which are generated from a pool of assets without directly the investors owning the asset itself, and that goes through the SPVs to the investors. If I may, I like in this video, if I may, I'll highlight one of a chart which I have recently analyzed and I found out in the internet. So I am seeing that PTCs has grown a lot and it has come to the level of direct assignment. Historically, direct assignment without an SPV was the preferred way of securitization. Now we see that PTCs are also growing. So I'll share the figure if I may pop it up in this video. Otherwise, I'll share it separately. Now, a recent milestone in the Indian securitization market that we saw was the listing of the country's first mortgage-backed PTCs on the National Stock Exchange. Now, what are these PTCs or mortgage-backed? So, these are basically pool of housing loans originated by LIC Housing Finance, and marks the first instance where the coupon is discovered through the NSE platform. Now, the PTCs carry a final maturity of approximately 20 years and offers a coupon rate of 7.26% per annum. The instruments has been assigned top rated by the CRISIL and the CARE ratings, and it is issued in a dematerialized form. So basically, due to its stock market listing, it is directly issued in the secondary market. This is the new residential mortgage-backed securities which are given in securitization manner through PTCs, which has been developed, which has been originated for the first time in India, and it has happened very recently. There was a news regarding it. So basically, my personal take as a conclusion, the headwinds in the future, what I believe is going to happen is that personal finance and microfinance is seeing a rising default rates. We are seeing how basically simple loans which are backed by which are or are not backed by strong collaterals are not helping the market a lot. Basically, what banks are doing is banks are typically, they are the buyers in this regard, but they are also becoming sellers in this securitization models, as we also know how loan receivables are being transferred into an asset of securities and being so originally it was being sold off to banks, now it is being sold off to private equity investors as well. So that's a development which I'm seeing. So basically now we are turning more towards secured lending, where security may be more of a sense that the value or realizability of the collateral is much more important than the asset itself. So as global trade turmoil has been happening, we see how the Trump tariffs has been hitting. There was multiple excess spread impact which has been happening. The cushion rate for realization of the collaterals, the safety net for the collaterals has been declining due to the global trade deficits and the highlights of the tariffs that we have been seeing. So it was a very challenging time for the financial sector entities. But also I want to highlight a very important thing, that another significant risk that I have identified from this long-term loan portfolios is the climate risk. Now basically Indian states face significant risk of climate-induced dislocation of population. We are seeing with the rising temperature, the global warming, nobody is caring about the environment. But yes, we are talking about green hydrogen, but we are a long way than going to that zone because of the level of carbon emissions that has been also increasing. So we have to lower that first. Now the risk of extreme weather changes is also very quite evident. Now these changes may impact long-term loan portfolios because the build-up of this impact is very becoming faster as anyone can expect. So any type of climate finance bonds or green financing bonds which are being issued by World Bank or IMF, I think more of these bonds should be popularized by the Indian banks as also, so that more and more farmers can take the risk of basically securing the lending which through a strong collateral that they can link it to agricultural based or anything, particularly in the green financing space. So these were my personal take. While I believe that residential mortgage-backed securities, which are RMBS in short form, it remains the goalpost still, because the agenda is still of the home loan securitization which is working. But I believe that it is the other part of the climate financing and the climate financing based securitization is also another aspect of which is basically being a slow moving part of the securitization that is also capturing the market. So this was, I wanted to give a small crisp analysis of 20 minutes. Probably I'm overshooting the time probably, but this is what I wanted to say about securitization. In the next video I'll come up with some other topic which I feel is very interesting to me or fascinating to me, so I'll share accordingly. So I hope you like it. Thank you very much.